Okay, we're back, folks, and I believe we have Mr. Z, John from Philadelphia on the line. John, are you there?
Hey, Larry. Good morning, Larry. Thank you for taking the call.
My pleasure, my friend. What can I do for you?
Say, by the way, we will look forward in anticipation of your 3:30 conversation on Tom's show with Arch. That's always fascinating stuff.
Yeah, he's a lot of fun too. He's a nice guy.
Larry, thank you for posting the chart on the natural gas. I called in about bonds, but let me just add a thought on the natural gas. The pattern and its implications you showed, speak for themselves. I will share this with you. This winter, 2017-18, thus far, now marks the third consecutive United States winter that's warmer than average. And I don't know if that will continue. Two factors. Sometime in the future, we're going to get a winter that's colder than average. And one observation about today, despite the fact that the winter is actually warmer than average. Now, yes, there was a major cold spell in New York, Christmas to New Year's into January 15th, and now it's cold out in the West. Be that as it may, it is nonetheless warmer than average season to date. That season starts November 1st. And in spite of a warmer than average winter, the use of natural gas, as seen in the drawdown of stockpiles of natural gas and storage, the data that we get every Thursday morning from the government at 10:30, shows that the drawdown in wintertime inventories is greater than average. So it's warmer than average, but natural gas is disappearing more quickly. What that says to me, coming sometime either in the next 9 months, 12 months, might be 2 years away, we'll get a colder than average winter, and prices will not be in this $2.50, $3 range. They'll be dramatically higher. So I just share that with you.
That's a great point, John, because when you start to see changes in things like that, in other words, if you have excess supplies and the market is not going down, that's telling you the demand is there. You might not know why, but at least you can see the demand is coming in at this level. So that's very important. Now, you mentioned that you might have a question about the Treasury bonds. I posted the long-term 30-year picture of Treasury bonds because I wanted to talk a little bit about that because, Mr. Buffett was on the tube today on CNBC talking about how this has been such a terrible tax on people that have owned bonds because the interest rates have been so low. What he failed to talk about is that if you owned bonds, you get the capital appreciation because when they go up, you have more money, you have less interest coming in on the bonds, but you have the capitalization of the bond. So, there's a sort of two-edged sword there. You got to look at both sides of it. But to me, we have made a major top back in 2016 in June of that year when we hit that 170 level, which was an aberration because they changed the contract specifications. But to me, we're going to be looking at rates are going to get back into that normal range when we get bonds down to about that 99 level, which means that long rates would be around 5.5%. That's my 2 cents. You had a question? Go ahead.
Thank you very much. Last Friday, you showed a bond futures contract 4-hour charts.
Yes.
And in that chart, you showed one of your classic and favorite patterns. It was either butterfly to a bottom or 3-drive to the bottom, one of the two.
It's a 3-drive.
And lo and behold, yes, the bond futures bottomed after that FOMC minutes, I guess it was, last Wednesday. Bottomed down at 142.14, bounced a bit, came down a higher low, 142.24. And now we've rallied 2 points. Now, full disclosure, I'm flats. I didn't take the buy. I can see why traders would have tried to buy. So my very specific question is this. Assuming you had bought the bonds down at 143, 142.24 Friday, say, 1, 2, 3 a.m., you have a very good unrealized gain at this point. My question, Larry, where is the point looking at your chart work, where you book gains on a long, assuming you bought it down there at that 143 level, please?
Well, John, like you, I was watching other things and I sort of missed the bottom. I saw it coming, but during the time that it happened, I was doing something else that turned out to be okay. You know, we've been very bullish these grains for quite some time, and that's worked okay. But getting back to the bonds, the main thing is what I do, John, is if I'm going to risk a half a point, which is $500 in bonds, if I make half a point, now my risk is zero. Because now if I don't take part of my profit there, and I'm talking about multiple contracts. If you trade two, you should take one at your break-even point. Then you put your stop at break-even on the next point. So you're guaranteed a $500 profit on the trade, even if it goes down and stops you out. So you're trading risk-free. Because I don't know how high bonds are going to go, but nobody else does either. They've gone two full handles, so they've gone not only $500, but they've gone $2,000, and you'd still have your second one on. So you made $500 on your first one, and $2,000 on your second one, and now all that money is yours. I mean, when you look at your equity run, it doesn't say potential profits there. That's your money. You can see the dollar sign, and that's the key here to look at. So you want to use a trailing stop at this level, but and sometimes I don't swing for those. I don't swing for the fences very much anymore, John. I enjoy trading, and I like the fact that I can quantify my risk really small. Looking at patterns that are 4-hour or hourly or daily. The smaller ones is what I'm looking for. But look at a long-term pattern. Not very often do I do that. And if we look at this Treasury bond on a daily basis, and this would really be a surprise to a whole lot of people, and that is we could get a rally all the way up to a 382 retracement of the high that we made at the end of last year, up around that 148 level, because that's only 4 handles. And John, we've made 2 of those handles in just a matter of a few hours. So we have the potential to see a 148 print in Treasury bonds, which I think would be the sale of the century, but that's what I'm possibly looking at.
Okay, very good. I appreciate that input. Thank you on that. In closing my call in to you, could you kindly share your guess to this question? The euro. The euro made a high back on February 15th, I believe it was, up at 125.5. Is there anything that you see in the long-term pattern, Larry, that suggests to you it is possible that 125.5 is a major top, and that the euro versus the dollar is now in the early stages of decline that goes down to 117 and conceivably much, much lower than that?
Absolutely, John. I'm going to post up here a 4-hour chart so the folks can see it, whether we can finish it during the time before the commercial, but we'll get back into it. But if you'll notice here on this euro chart, John, stay with me for the break. Could you please be with us after the break? Thank you very much. We've got Mr. Z on the phone. We'll be right back talking about the euro. Okay, we're back, folks. We're talking with Mr. Z from Philly about the euro, and I've posted that 4-hour chart going back in the last 6 weeks. You can see the beautiful patterns. The harmony between the low and the high has been nearly perfect. But what the question is that has been asked is, what is the real outlook for the euro on a longer term basis? So I think what we'll first do is we'll look at it on a weekly basis, John, and I'll post the chart up here because this is the one that I use in my newsletter frequently for better projections. But you'll notice that the high we made there right below the 126 level was a 61% retracement of the high from 2015, and it was also a 1.618 expansion of the high from 2015. So 2014 on the 61%, 2015 on the 1.618%. Now, what we'll do now is expand it just a little bit farther to get a little larger look, because this is the one that gave us a relatively big clue that the euro was making a really good bottom down there at that 104 level, because it had all kinds of cycles and things happening. And if we put this up here to take a look at it, you'll see the long-term monthly. Now, John, if you look at the period between 2012 and 2014, the euro went from 119 up to 139. It moved 20 handles. And what have we done so far? We've gone from 103, we've gone up to 120, 125, 21 handles. You notice how similar those moves are? And it's coming in exactly at a 61% retracement for the high in 2015. 14, I think we made a major high in the euro, frankly.
Thank you so much for sharing that. I will tell you, I always get confused in examining what the fundamentals are, debt load, central bank policy, and then market sentiment. But and I'm also a very poor forex trader, since I like to kind of get a handle on what's likely to unfold the next 12 months. So I don't trade forex that often, but right here, right now on that euro, that potential of 125 being the end of a 2.5-year bounce leaves me very interested in speculating on the short side, and of course minimizing my losses in the event that I'm wrong. So thanks for sharing all that. Appreciate that, sir.
Well, one of the things that we watch, John, is that, last night's trading, we went up and we took out the highs of the previous day by a couple of ticks and then rolled right back over on that 4-hour chart. So that's another sign that says there's just not a lot of power coming into it right now. So we'll see. But there's a really good, we'll be watching that very, very closely.
Thanks so much. I'm going to sign off. Thanks for the show. Look forward to Arch this afternoon. One last thing, please. Sometime during the coming week, if you could spend some time talking about corn. Corn has been very quiet, very range-bound for 18 months. I'm thinking the chance exists for that to change with a bull market unfolding, so I'd appreciate that sometime later.
Would be happy to, and I think it's important because you've been alerting us about what's happening in South America, and the weather has turned. They were supposed to get rain, and all of a sudden, the last 2 weeks that the rain was supposed to come, there was virtually none, and so we're seeing strength in wheat, corn, and especially soybeans. This morning, with the position we were looking at in soybean oil about $800-900 ago, has really started to work. We want to thank you for alerting us to that too. So keep up the good work, my friend, and go Eagles.
Yes, sir. Enjoy that snowfall coming this week, Larry.
We certainly will. Thanks a lot, John. We appreciate your help here at TFNN. You do a great job for everyone.
Bye now.